All right. Can I erase this?
Yes.
Yes? Okay. Third financial statement. Balance sheet. Header, who, what, and when. Classified balance sheet. What's the first thing on the balance sheet? It's a header. It's called assets. Under assets, you want to break it down into current assets. Okay? What are our current assets? Cash, of course, is, because cash is king. It's also the gold standard in how we determine what is current. How much cash do we have? $10,000. Second, the next thing that's going to turn into cash is accounts receivable. And we have $25,000. The next thing is inventory. And we have $25,000. Is that all of our current assets? No. Nope. We have prepaid rent, right? And we have $5,000 of that left. Then the next thing on the chart of accounts is equipment. Is equipment a current asset? No. It goes under its own category. So we're going to go total current assets. And my total current assets are $65,000. Somebody check my math. Yes, ma'am.
Do we have to separate them that way, current assets and long-term assets?
If you're doing a classified balance sheet, yes, you do. Okay? And I promise you, if I ask you to do a balance sheet on this test, it will be a classified. Okay?
But for our meeting project, were we supposed to do that?
Yes. Yes. Okay? So there's my current assets. The next thing up is equipment. So I would have a new category header, property, plant, and equipment. My first account in there would be equipment, of which I have $36,000. And I have accumulated depreciation on that of $12,000 here. Add those together, you get net equipment of $24,000. Sorry. I'm going to save that column. Total property, plant, and equipment, I'm going to abbreviate, of $24,000. Everybody with me? Questions? Show the asset, less accumulated depreciation, show the total. Okay? Do I have any other assets? Any non-current assets? What's the next thing on my trial balance? It's accounts payable, so it would be a liability. Just turn it, not the whole tripod. Okay, because you're messing it up. Okay, so if these are all of my assets and I have no long-term assets, what's my next line on here? Anybody else? Total assets. There we go. Is $89,000. Okay? So look at what I've got. I've got a header here, assets, a subheader of current assets, the total that goes with it, a new subheader called property, plant, and equipment, the subheader or the total that goes with that subheader, and then total assets. Notice I try and line all these up. I did the best I could on a whiteboard, mind you, with no lines. And I try and line these up, and I try and line up all of my accounts inside of it. Try and make it nice, neat, and tidy, right? Excel's a great tool for lining stuff up like that. Yes, ma'am?
So current assets and property, plant, and equipment will be on
The same level. They're one step in. Yeah. And then each individual account is one more step in from that. Okay? So there's total assets. Somebody said what was next already. What was it?
Liabilities.
Liabilities. I'm going to come up and do a side-by-side because I'm running out of board down here. So we're going to do liabilities as a header at the top. Okay? And what's the first part of my liabilities? What? Current liabilities. Remember, classified balance sheet. And yes, accounts payable. And I'm abbreviating again because I remember the rule. I can do that on the board. Accounts payable, I have a balance of $12,000. Do I have any other current liabilities? No. The next item on my chart of accounts is capital. So do I have any other liabilities at all? No. So total current liabilities and total liabilities. So again, notice what I've done is I've got my header, section total, total to go with my header. Again, I'm attempting to line these up, step it in so that each one is offset and it's easier for the reader to follow. Good? Okay. So I've got total assets, total liabilities. What's next? What?
Capital. Owner's equity.
Owner's equity. Yes, capital, but the header is owner's equity, right?
Also the title of the sheet.
What's in owner's equity? Capital. Ending. How much is my ending capital? Did we write it down from our
77,000.
state?
77,000.
Okay. Why isn't it 57,000 off of our balance, off our worksheet?
It includes our income.
Yep. So from our statement of owner's equity, we had 77,000. I have no other capital items, so I get total owner's equity. Now what do I get? I have assets, liabilities, and owner's equity. What am I missing?
Liabilities plus owner's equity.
Total liabilities and owner's equity. Correct. And this is where I add this number and this number together to give me 97. I can't add. What? 89. I'm dyslexic all of a sudden. 89,000. Again, it's doing math too late in the day. So assets, liabilities, owner's equity.
Balances.
I'm in balance. Life is good. Yes? Okay. Questions? Ron?
It's not about that sheet, though. It's about the worksheet.
Let's go back to the worksheet then. Over here?
Yeah, it's about the adjusted trial balance. If I look at inventory, I see a debit of 25,000, even though there's a debit in the trial balance column of 30,000, debit in the adjustments column of 25,000. You've essentially totaled that. However, when we go down to the income summary line, you did not total that. Why is that different?
this is what we were talking about before. I've reflected my beginning and my ending inventories here so that when I do my balance sheet and I do my income statement, I have both the beginning and ending inventories in one place on my worksheet, and I don't have to go look for them somewhere else.
Now,
Okay?
look for them in the trial balances.
Yes, you could look for them here instead of here, but we put them in both places. That's just the convention.
It is a convention.
It is. Okay? Other questions? All right. So that gets you through the financial statements. Can I erase the balance sheet? And what would we do next? What?
Post.
What?
Journalize and post your adjusting and then closing.
Journalize and post the adjusting entries. Okay? Everyone comfortable with that, or would you like to do that? I want to sort of do it.
Can we keep that last column now for a second?
This one? Okay.
I guess probably the only thing that you had a separate entry for the inventory and income summary under the page for adjustments.
That's what I wanted to do. Okay? I want to put up our income summary. Because I wanted to follow your question as to why those aren't why they're adjusting entries and not closing entries.
No, that's really not my question. My question, because they both end up in the T account.
They do.
The issue is whether or not you add them on the adjusting entries page or the closing entries page.
Oh, they go on the adjusting entries page.
So you do need to make a separate entry on the general journal just for
that.
that.
Yes.
Okay.
Okay? So, but I wanted to walk through this. So my entry involves a debit of $30,000 and a credit of $25,000 to the income summary. And those are both identified as item C, where I adjust my inventory balance. Okay? So let's assume we've posted all of the adjustments, okay, and let's just move on to the closing entries, unless someone wants to do the adjusting entries. No? Pretty straightforward, right? We've done it a few times. Okay, so my closing entries, do I do anything with my balance sheet accounts? Someone shake your head yes or no. Do I do anything with this? I have a no over here. The rest of you, no, we don't do anything with our balance sheet. That's why they're called permanent accounts. It's the income statement accounts, the ones that are referred to as temporary accounts, that we want to make the balances go to zero. So we set up our general ledger for the following month. Okay? So the first thing you do is you would take all of your revenue accounts or all of your accounts with credit balances and we zero them out, correct? Okay? What are they? We're going to exclude the income summary account. So I only have the $64,000 and the $2,000. I have sales and purchase returns, right? So I would need to debit both of those accounts and credit income summary for $66,000. So I'm going to do that. And I'm only going to show the one end part of the entry because I'm just working through, I just want to focus on the income summary for a second. I'm going to list that as R for revenue accounts. Everybody with me? Good? Okay. Step 2 is we would take all of our expense accounts and we would want to zero those out. So to zero those, you have to post a credit and there would be a corresponding debit to income summary. Okay, it's $37,000. So I would have a debit of $37,000 and I'm going to call that E for expenses. Good? Everybody with me? So all of these accounts except for the income summary, have zero balance at this point. And all of those balances have been moved to the income summary account. Good? Okay. Real quick, what's our balance in the income summary account? $24,000. Good? Did you do the math that quick, or do you just remember what net income was on the income statement?
On the left side, it was 67,000, which was one higher, so I subtracted one from 25.
Perfect. Okay, he did the math that fast. You're the official math keeper of the kingdom from now on. But remember what this number was. This was net income from our income statement. Remember I said write it down, we're going to need it? So this actually represents net income from the statement. Good? Now, here's what I want to walk through. If I had just closed the expense accounts and the revenue accounts to income summary, would my balance in this account have been $24,000? I had to make this entry for the difference in the beginning and ending inventories to get the right net income number here, correct? So that adjustment has to flow through this income statement so that we affect the owner's capital by the correct amount. Good? Okay. Step 3 is zero out the income summary, post a debit, and post the corresponding credit to owner's capital account, correct? So owner's capital goes up by $24,000. Step 4 is come get the drawing account, credit the drawing account, and debit owner's capital by $4,000, which lowers it by $4,000 and takes it to its true ending balance, which that number would then match the statement of owner's equity, and it would match the amount we're showing here on the balance sheet. Good? Those are all your double checks to know if you did it right.
It would match what?
It would match both your balance sheet owner's equity and your statement of owner's equity ending equity balance. Okay? Questions? Questions? Anybody? Answers?
The R and E stand for what again?
Oh, that's my closing the revenue accounts. That's my closing the expense accounts. Other questions?
I'm sorry, one more time, that balance is going to equal the owner's, on the balance sheet?
After you post this entry to the owner's capital and you close the draw to the owner's capital, the balance of owner's capital will match the number that you're showing on the balance sheet for owner's capital, and it will match the ending capital amount from the statement of owner's equity.
He's talking about the general ledger account.
The general ledger account now matches the two financial statements that you prepared. Yes, that's a great way to put it. Anybody else? Okay. Okay, so the drawing account has a debit of $4,000. The owner's capital has a beginning balance of $57,000 credit. So when we post the debit to zero out income summary, we would post a credit, which increases capital, and then we would zero out the draw, and we would debit owner's capital.
I have
Okay.
in the past, my brain is just scrambled eggs.
Well, I wanted to point out, remember when we did the calculation of owner's capital, the statement of owner's capital? We had 24,000 in additions, and then we subtracted 4 for total change of 20. So we ended up with a balance of 77,000.
So that was already accounted for.
And now this matches what's on the balance sheet here, and it also matches what's on the statement of owner's capital,
I just wasn't sure, I forgot what I was.
owner's equity. Okay. So that's the whole ball of wax there. All right, other questions? Okay, So posting the adjustments to the general ledger is your question. So these are your adjustments on the worksheet. You would do this, you would prepare your financial statements from your adjusted trial balance column. Then you would post your adjustments to the general journal and then the general ledger. So to go to the general journal, we'll do them in order. A was first. You would have rent expense, a debit for $1,000, and then you would credit prepaid rent for $1,000, right? Then you would have accumulated depreciation, so you'd have depreciation expense, a debit for, I believe it's $1,000, a credit to accumulated for $1,000. So that's your second entry. Your third entry was the inventory entry. So you've got a debit, or what was the first one? You got a credit to inventory, a debit to income summary for $30,000, and then you've got a debit to inventory to add the ending inventory, and a credit to income summary for $25,000. Like that. So there's your 4 adjustments.
That's the general journal?
And that goes in the general journal, and then you post each of these in the general ledger. And remember, up at the top of this page you would write adjustments. So there's your description for all of them. You'd get the date, and then you go and post those to the general ledger. Okay? So at that point, you're ready to move into what we've already done, which was the closing entries. So you'd go to a new page and you'd write closing entries, and you'd write the general journal entries for the closing entries. And then you'd go post those to the general ledger. And the last step, after you post the closing entries to the general ledger, is, anybody? Post-closing trial balance. Proves all of your temporary accounts have 0 balances, and it proves you're still in balance. Good? Okay. Other questions? Yes?
Question from the mini project. Do we have to do the accounts payable, subsidiary ledger?
I believe it tells you to do that, yes. So an accounts payable subsidiary ledger is just a list of all the vendors that you owe money to and the balance.
And it was on our to print them out?
Yes. And when you total up the list of all of those vendors and the amounts, the ending balance should match your general ledger account for accounts payable, which in our example over here was $12,000. Not that they're related at all, but it should match the general ledger account is all I'm trying to point out. Okay? Other questions? Yes, ma'am.
Can we go over how do we fund the payroll?
How do we fund the payroll?
Or how do we report the entry?
Sure. So you're saying we've already completed the payroll register,
Yeah.
and we've made the entry off the payroll register? Okay. Again, can I do some more erasing? Everybody's got what they need here? Okay. Let's have some fun with this. Why don't you read me the entry out of the mini project? Right? I need numbers, so let's use those. So let's read the entry, and we will post the payroll first, and then we'll post the one where we actually pay it. Okay?
So on the 29th, it says reported the October payroll. The records prepared by the payroll service show that the
Okay, hang on. So that's going to be total earnings for our employees. What account does that go to?
Salaries,
Yeah, I called it wages expense when I wrote it up here. And it was how much?
10,900.
10,900, okay. 800? I apologize, 800.
And there's Social Security for 702?
Social Security what? Withheld from employees' checks?
Yes.
Okay, so we're going to have, and I'm going to abbreviate, Social Security payable, and it was how much?
702?
702. Remember, it came out of employees' checks, and we don't get to keep it. We owe it to the government, so it's a liability, so it gets a credit.
Okay.
Okay? What's the next one?
Medicare?
Medicare payable. How much is it?
162.
162. Again, it came out of the employees' checks. We don't get to keep it. We owe it to the government. It's a liability, therefore a credit. Okay? Next.
Income tax?
Income tax. And that was withheld from employees' checks. We don't get to keep it. Therefore, it's also a liability. How much is it?
1,020.
Okay.
And then the net pay was 8,916.
Okay. Are we paying the payroll to the employees today?
No.
No. Okay. So how much was it again?
8,916.
16?
Yes.
$8,916. I'm betting that if you add this up, we're in balance.
Yeah.
Okay. What account does that get posted to? It's a liability. I used wages, so I'm going to say wages payable, okay?
There was a big question.
So this entry is done in the general journal and then posted to the general ledger, right? And it came.
This is to report payroll?
This is to record the actual payroll.
Okay.
Okay. Now, later on, it says paid the payroll. And how did we pay the payroll? We wrote them checks.
Right.
So if we wrote checks, which journal does it get entered in?
Cash payments.
Cash payments journal, exactly. So I could draw a cash payments journal up here, but you're going to have a date and you're going to go straight over to the other section and you're going to list. So there would be an other, and over here you would have cash, credit. Others would be debit, right? Okay, so we'd come over here to other, and we would have the wages payable account, and we would debit that for the 8,916, and our credit to cash would be the 8,916 when we write the checks. So you've taken care of it.
So we need to debit there because we have credited when we record the payroll.
It's a credit here.
So now the payment is going, the cash is going out.
Cash goes down, which is a credit. Wages payable gets debited, so this balance that we put here goes to zero.
Okay.
So in the end, on your worksheet and your trial balance, your wages payable account has a zero balance. Okay?
So that's the problem with it lists the individual checks for each employee.
Correct. It doesn't list each one. It just says paid the payroll on checks 101 through 106 or something like that. It just says a range.
So that's how we write it, just like that?
There would be the rest of the cash payments journal here. I didn't draw the whole thing out. Okay? But I just said, here's the other column, and here's the cash credit column, and that's where it would go and how it gets entered. Okay? Are we good?
Yes, but then it goes to recorded employers' payroll taxes.
Record the employer's payroll taxes.
So it's like the second piece.
Okay. Where do the employer's payroll taxes get entered? General journal. So I'm going to switch back to general journal. And does it tell us what the employer's payroll taxes are?
Yeah.
Walk me through it.
Okay. Social Security,
I'm going to, okay. So Social Security payable, right?
yes.
Okay, so I know, what's my debit going to be to?
Payroll taxes expense,
Payroll tax expense. Eric, are you aimed low enough?
Yeah.
Okay, so for now we don't know what that is, but I'm going to put it up here as my debit. My credit is going to be to Social Security payable, Medicare payable. Does the employer match the income tax? No. Okay, so how much is my Social Security tax payable?
702,
Notice it's the same amount. How much is my Medicare payable?
162.
162. Okay, same amount because the employer matches. Is there anything else given in the problem there?
That's part, the confusing part. I did it right, I just didn't understand why we had credited 2 times.
Ah, got it. So this is 864, right? I feel good because it...
More to it.
Oh, tell me the rest and then we'll walk through your concern.
So statement unemployment tax, 584?
State unemployment, SUTA. How much? 584?
Yeah.
Okay. And federal unemployment tax,
118.
118. What do all those add up to? Are there other things? No.
That's it.
What do,
1,566.
1,566? 1,566. So the debit to payroll tax expense is 1,566. Okay? And here's what's going on. We have 2 entries. This one, which records what was withheld from the employee's check, and this one, which is the employer's part. So you've got an employee and an employer part of the tax. So for Social Security, it's 702 and 702. For Medicare, it's 162 and 162. For income tax, it's 1020 and 0, because employer doesn't match it. For FUTA, F-U-T-A, and SUTA, the employee doesn't pay it, but the employer does. Like that. So if I take this out of the way real quick, you can see these things are going here, and all of these come from down here with the employer's part of the tax. Okay? So the employer matches the Social Security and the Medicare, does not match the income tax, but they pay all of the federal unemployment and the state unemployment tax. Okay?
And we know all that from the payroll
Register. Correct.
Did you fill it out?
Okay. Practice. Do some homework problems before the test. Yes, ma'am.
So what does EE and ER specifically stand for?
EE is kind of standard nomenclature for employee, and ER is employer. Employee and employer. Okay? Okay. Other questions?
On our test, are you going to kind of word it like the maybe question, like say, you're going to say, do da 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 da, now, do da 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 da.
Yes.
Okay.
Yes.
Does that language work? My language to that?
Yeah, that's fine.
Can you say again what we did on the first entry? So the first entry we recorded.
Okay.
payroll.
You did a payroll register, and it says that total wages expense was $10,008. This was withheld from the employees for Social Security and Medicare and income tax, and the net pay to the employees is $89.16. So we record that.
So we just recorded payroll.
We record the expense and the corresponding liabilities because we haven't paid the employees yet. In between, we pay the employees so that the wages payable goes away. Then we sit down and we calculate the employer's part of the tax. And we record that. So we have payroll tax expense and more liability for what we owe to the government for Social Security, Medicare, and then we have FUTA and SUTA, federal unemployment and state unemployment tax.
Did we ever, on the
So-
general ledger?
When we make the payment to the government, we have to add these to these and pay in the proper amount. Okay? Do we ever what?
It goes in the same bucket like Social Security payable. Do we separate what is employee and what's employer? I know it's the same amount because it's matching.
No, because it's the same liability account. You put them both in the same general ledger account. Say it with me, general ledger account. Raise your right hand. I promise never ever to call them a bucket again. Okay? Okay. All right. So does that get you the answer? Okay. Anything else? Lauren, did you have a question? I got you covered? Okay. Anyone else?
When you're doing an income statement, the book, the way that they put the numbers in, it's really hard to follow. Does it matter?
When you're doing an income statement,
So it has like 4 columns.
oh, the different columns?
From like out in.
I am more concerned that you present it in a way that's easy for the reader to understand what's going on. So if you don't absolutely memorize their 5-column format and use 5 columns, I'm okay. If you only use 4 or only use 3 somehow, I'm okay with that. All right? But the easier it is for the reader to see and follow, that's really the objective. Okay? Okay. So, we'll get that in a minute. For the cost of goods sold section, and I'm going to abbreviate, cost of goods sold, you have beginning inventory. Okay? And then you have purchases. You could have freight in. You could have purchase discounts. Okay? This gives you, you add, I'm going to put numbers in here, 1,000. Beginning inventory is 1,000. Purchases is 500. Freight in is 10. Discounts is 10. Okay? Makes my math easy. That gives you net delivered cost of purchases. So that's 500. Okay? I'm only totaling here. From that you subtract less returns of, let's say, $100. And what's the next header we get? Somebody look real quick.
Total merchandise?
No, there's one more line before total merchandise available, right?
Net delivered cost?
Net delivered cost of goods. I'm sorry, what was this one then? I called it net when I shouldn't have. Net delivered. Yeah, what's the one right up above? I want to get it exactly like they do it in the book. What?
Delivered cost of purchases.
Oh, it is delivered cost. And then I go net after I subtract. So this is going to give me 400. Okay, so purchases, freight in, purchase discounts, delivered cost of purchases, less returns gets me net delivered cost of purchases. Then I add that to beginning inventory to get total goods available for sale. and this would be 1,400. Okay. Then I would have ending inventory. And how much is our ending inventory? Pick a number, anybody. 10,000? That would blow up my whole problem, wouldn't it? 200? My ending inventory is 200. Okay? So if I take my total goods available, I could have sold $1,400 worth of stuff, but I have 200 left over. I get cost of goods sold of $1,200. Everybody good with this? Questions?
This is a lot more easy to understand than how they explain it in the book.
That's why I'm here. Right?
If we do this kind of format in the test, they will be considered.
I'm okay with this.
Okay.
It gets you the right place.
Okay.
Yes, ma'am.
So, some of the numbers being on the right, some of them on the left, has nothing to do with debit or credit.
No, ma'am.
Okay, always
Okay, hey,
that, but I always just,
This goes all the way back to chapter 4 when we started doing financial statements, income statements, and balance sheets. This is just me showing you how to make it easy to read. This is not debits and this is not credits. I could have 3 or 4 columns here, like the book does, right? It has nothing to do with debits and credits once you're putting it on the financial statement, either the balance sheet income statement or statement of owner's equity. Okay?
when I was doing the project today, in the beginning of the semester, I was really good at like knowing the assets and liability accounts, like knowing like the plus, minus, credit, debit and stuff. And then today, when I was like, I totally lost that. I even just being able to conceptualize it in my mind. I don't
Really?
know like how to go back.
If you go back to, which chapter was it? 3, where I had the chart that listed the 6 different possibilities, right? Which accounts increase which way? So let's make it simple. Which accounts increase on the debit side? Assets increase, debit side. Assets, expenses, and draw. Okay? Then there's 3 sets of accounts that increase on the credit side. Increase credit side, and that's liabilities, revenue, and owner's capital.
My thing today was just doing like the sales purchases and returns or the purchase allowance. I don't even know. It was like that. Like, how do I know where those ones like?
Okay. Can I erase my cost of goods sold?
Yeah.
Okay. Purchases, returns, discounts. You've got the whole fixed assets accumulated depreciation thing straight in your head, right? Assets are a debit. The accumulation is a contra. Accumulated depreciation is a contra account, so it's a credit. Correct? Okay. So purchases are an expense. That's our cost. So if we buy something, that's a cost. It's a debit. If we return it, we no longer have the cost, but we track it in its own account. It's a reduction of the cost. So it's a credit. And just like equipment and accumulated depreciation, you have to net the two together to get to your net cost. Same things with discounts. It's a reduction in our cost. So it's also a credit. Okay? That's purchases. Purchase returns, purchase discounts. Okay? Then you have sales, sales returns, sales discounts, and all these flip because sales always has a credit balance.
Purchases goes plus and minus, plus and minus return.
Debit and credit.
Yeah, but they are a debit credit, it's just what increases.
Which one increases? Yes. So remember, purchases is an expense item. So it increases as a debit, the decreases are credits. Sales, on the other hand, always increases on the credit side. And the sales returns and sales discounts would have to be debits to decrease that. That's how to keep them straight. Okay? Yeah, anytime. Next question.